year 23-24 so far, that is up to July 28th, as compared with 5.7 lakh crore a year ago. So just to repeat the figures, the flow of resources to the commercial sector in the current year so far is 7.5 lakh crore, and in the corresponding period of last year it was 5.7 lakh crore. On the downside, however, merchandise exports and non-oil, non-gold imports contracted further in June, and the growth in services exports decelerated amidst slowing external demand. Looking ahead, these underlying developments and the upcoming festival season are expected to provide support to private consumption and investment activity. The spillovers emanating from weak external demand and protracted geopolitical tensions, however, pose risks to this outlook. Taking all these factors into consideration, real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. Real GDP growth for Q1 of next financial year, that is 24-25, is projected at 6.6%. The risks are evenly balanced. Let me now turn to inflation. The moderation in headline inflation to 4.6% in Q1 of 23-24 was in line with the projections set out in the June MPC meeting. There was pickup in headline inflation to 4.8% in June due to an upturn in food inflation. On the positive side, inflation excluding food and fuel, that is core inflation, has softened by more than 100 basis points from its recent peak in January 2023. The month of July has witnessed accentuation of food inflation, primarily on account of vegetables. The spike in tomato prices and further increase in prices of cereals and pulses have contributed to this. Consequently, a substantial increase in headline inflation would occur in the near term. Going by the past trends, vegetable prices may see a significant correction after a few months. The prospects of Kharif crops have also brightened thanks to improvement in the progress of the monsoon. Uncertainties, however, remain on domestic food price outlook due to sudden weather events and possible El Nino conditions in August and September. August and beyond. Global food prices are also exhibiting a hardening bias on renewed geopolitical tensions. Crude oil prices have firmed up in the recent weeks, and its outlook is clouded by demand-supply uncertainties. Assessment of the future trajectory of inflation is a continuous process. We have a choice to modify our inflation projections in every meeting of the MPC if warranted, in the interest of better guidance, or avoid frequent changes and revise them only on fewer occasions for simplicity of presentation. Given the continuing uncertainties, our latest CPI inflation projection for 2023-24, assuming a normal monsoon, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Let me just repeat these numbers for better clarity. CPI inflation projections for 2023-24, that is for the current year, assuming a normal monsoon, as I have said, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Further, CPI inflation for first quarter of the next financial year, that is 2024-25, is projected at 5.2%. the risks are evenly balanced. Headline inflation projection for the second quarter of 23-24, that is, for the months of July, August and September this year, has been revised up substantially, primarily due to price shock from vegetables. Given the likely short-term nature of these shocks, monetary policy can look through high inflation prints caused by such shocks for some time. The frequent incidences of recurring food price shocks, however, pose a risk to anchoring of inflation expectations, which was underway and which has been underway since September 2022. The role of continued and timely supply side interventions assumes criticality in limiting the severity and duration of such shocks. In such circumstances, it is necessary to be watchful of the emerging trends and the risks to price stability. We have to stand in readiness to go beyond keeping Arjuna's eye to deploying policy instruments if necessary. I reiterate what I said in the previous June policy statement. Bringing headline inflation within the tolerance band is not enough. We need to remain firmly focused on aligning inflation to the target of 4%. With this, I would now like to take up the liquidity and financial market conditions. The level of surplus liquidity in the system has gone up in the recent months on the back of the return of rupees 2,000 banknotes to the banking system, RBI surplus transfer to the government, pickup in government spending and capital inflows. The overall daily absorption under the liquidity adjustment facility, that is LAF, was 1.7 lakh crore in June and 1.8 lakh crore in July this year. Despite such surplus liquidity, market response to RBI's 14-day variable rate repo auctions, that is VRRR auctions, was lukewarm. Instead, banks preferred to place their surplus liquidity in the less remunerative standing deposit facility, that is SDF. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market, this essentially, let me just read it again. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market, this essentially reflects greater risk aversion among the banks to park large funds under the main operation. In this context, it is necessary to reiterate that fine-tuning operations, that is overnight operations up to 13 days, are undertaken to deal with special or exceptional situations and cannot become a rule. In recent years, our stated stance on liquidity is to maintain adequate liquidity in the system to meet the productive requirements of the economy. Excess liquidity, on the other hand, can pose risks to price stability and also to financial stability. Hence, efficient liquidity management requires continuous assessment of the level of surplus liquidity so that additional measures are undertaken as and when necessary to impound the element of excess liquidity. Accordingly, it has been decided that with effect from the fortnight beginning August 12, scheduled banks shall maintain, I repeat, scheduled banks shall maintain an incremental cash reserve ratio, that is ICRR, of 10% on the increase in their net demand and time liabilities, that is NDTL, between May 19th and July 28th. I would like to read this sentence again so that the message gets across. It has been decided that with effect from 12th of August, scheduled banks shall maintain an incremental CRR, that is ICRR, of 10% on increase in their NDTL between May 19th and July 28th. And what I am now going to say is equally important. This measure is intended to absorb the surplus liquidity generated by various factors referred to earlier, including the return of rupees 2000 notes to the banking system. This is purely a temporary measure for managing the liquidity overhang. Even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. We have reviewed the position, and on that basis alone, on the basis of our internal assessment, I am making this statement that even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. The incremental CRR will be reviewed on 8th September or earlier with a view to returning the impounded funds to the banking system ahead of the festival season. I must add that the existing cash reserve ratio, that is CRR, remains unchanged at 4.5%. I would now like to focus on financial stability. The Indian financial sector has been stable and resilient as reflected in sustained growth in bank credit, low levels of non-performing assets, and adequate capital and liquidity buffers. Macro stress tests for credit risk reveal that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress scenarios. There is, however, no room for complacency because it is during tranquil and good times that vulnerabilities may creep in. Hence, buffers are best built up during these periods. A stable financial system is a prerequisite for price stability and sustained growth. This is a shared responsibility in which regulated entities like banks, NBFCs, and others are important stakeholders. On its part, the Reserve Bank remains steadfast in its commitment to safeguard the financial system from the emerging and potential challenges. We expect the same from the regulated entities also. As regards the external sector, India's current account deficit was contained at 2% of GDP in 2022-23 as compared with 1.2% in 2021-22. Merchandise trade deficit has narrowed in the first quarter of the current financial year, that is 23-24, with contraction in imports exceeding contraction in exports. Services exports and remittances are, however, expected to provide cushion to the current account deficit. We therefore expect the current account deficit to remain eminently manageable during the current financial year also. On the financing side, foreign portfolio investment, that is FPI flows, have remained buoyant in 2023-24, that is in the current year so far. Net FPI inflows have been $20.1 billion up to August 8, which is the highest since 2014-15. In the corresponding period of the previous year, there were net outflows of $12.6 billion. The inflows under external commercial borrowings also witnessed a turnaround with net inflows of $6 billion during April-June this year, as against net outflows of $2.9 billion a year ago. Net foreign direct investment, that is net FDI flows to India, on the other hand, fell to $5.5 billion during April-May 2023 from $10.6 billion a year ago, reflecting a global slowdown in FDI inflows or in FDI flows. Latest available data suggest that India's external debt to GDP ratio improved to 18.9% at the end of March 23 from 20% at the end of March 2022. The Indian rupee has remained stable since January 2023. Foreign exchange reserves have crossed the mark of US 600 billion. The umbrella has gathered strength, and I am not saying this in the context of the monsoon rains. I would now like to proceed and announce certain additional measures. As you would be aware, we announced several measures as a part of the MPC statement, and a number of these measures have very far-reaching consequences, and they make a lot of impact on our overall financial inclusion, on our financial, on deepening of credit, on the spread of UPI, and on other aspects of the economy. So we have a few measures. I request your continued patience. The first announcement relates to review of regulatory framework for financial benchmark administrators. It has been decided to revise the extant regulations issued in June 2019 and put in place a comprehensive risk-based framework for administration of financial benchmarks. This will cover all benchmarks related to foreign exchange, interest rates, money markets, and government securities. The revised directions will provide greater assurance about the accuracy and integrity of the financial benchmarks. The next announcement relates to review of regulatory framework for infrastructure debt fund NBFCs, that is IDF NBFCs. At present, infrastructure debt funds provide refinancing facilities for lenders in the infrastructure sector. The extant regulatory framework for IDFs has been revised. The key changes in the revised framework are: 1. Withdrawal of the requirement to have a sponsor for the IDFs. 2. Allowing IDFs to finance toll operate transfer, that is TOT projects, as direct lenders. 3. Permitting IDFs to raise funds through ECBs. And 4. Making tripartite agreements optional for PPP projects. These changes are expected to further augment the capacity for infrastructure financing in the country. The next announcement relates to greater transparency in interest rate reset of equated monthly installments based floating rate loans. Now let me just read it again, I think that was too long. It basically, the next announcement relates to bringing in greater transparency in interest rate reset of EMI installment based floating interest loans. It is proposed to put in place a transparent framework for reset of interest rates on floating interest loans. The framework will require regulated entities to, again there are various components, it will require the regulated entities to, number 1, clearly communicate with borrowers for resetting the tenor and or the EMI. Number 2, provide options for switching to fixed rate loans or foreclosure of loans. 3, disclose various charges incidental to the exercise of the options. And 4, ensure proper communication of key information to the borrowers. These measures will further strengthen consumer protection. The next announcement relates to consolidation and harmonization of instructions for supervisory data submission. The Reserve Bank has from time to time issued several guidelines on submission of supervisory returns by the supervised entities. It has been decided to consolidate and harmonize such guidelines into a single master direction to reduce compliance burden and to promote greater ease of doing business for supervised entities. And the next announcement, actually there are 3 announcements within this announcement. and it relates to UPI. And basically the announcements are related to bringing in conversational payments and offline capacity on the UPI, enhancement in transaction limit of small value offline digital payments. The details are as follows. With the objective of harnessing new technologies for enhancing the digital payments experience for users, it is proposed to, number 1, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments. Number 2, introduce offline payments on UPI using near field communication technology through UPI Lite on device wallet. And number 3, enhance the transaction limit for small value digital payments in offline mode from rupees 200 to rupees 500 within the overall limit of rupees 2000 per payment instrument. These initiatives will further deepen the reach and use of digital payments in the country. And this is the final announcement, the next one, and it's really impactful. We expect this announcement going forward will have a huge impact on our credit sector. The Reserve Bank, in association with the Reserve Bank Innovation Hub, started a pilot project in September last year for frictionless credit delivery through end-to-end digital processes, starting with Kisan Credit Card Loans, that is KCC loans. The pilot for KCC loans is currently operational in select districts of Madhya Pradesh, Tamil Nadu, Karnataka, UP and Maharashtra. Recently, dairy loans have been included in the pilot project in select districts of Gujarat. Based on the learnings from the pilots and to expand the scope of end-to-end digital lending processes, a public tech platform for frictionless credit delivery, I repeat, a public tech platform for frictionless credit delivery is being developed by the Reserve Bank Innovation Hub. The platform is intended to be rolled out as a pilot project in a calibrated manner. It will have an open architecture and open application programming interface, that is API and standards, to which all financial sector players can connect seamlessly. This initiative will accelerate the penetration of credit to the hitherto underserved regions and further deepen financial inclusion in our country. Let me now conclude. We have made good progress in sustaining India's growth momentum. While inflation has moderated, the job is still not done. Inflationary risks persist amidst volatile international food and energy prices, lingering geopolitical tensions, and weather-related uncertainties. In charting the course of monetary policy, we continuously assess the impact of our past actions, the evolving inflation dynamics, and the implications of the incoming data for the economic outlook. I reiterate our commitment to align CPI inflation to the 4% target on a durable basis. We do look through idiosyncratic shocks, but if such idiosyncrasies show signs of persistence, we have to act. As we prepare to celebrate the Independence Day, the air is filled with hope and promise. Let me end by recalling the prophetic words of Mahatma Gandhi, and it is as follows. I have no doubt that our country would rise to the greatest height among the nations of the world. Thank you. Namaskar.
Okay, that was the RBI policy for you. Rates unchanged at 6.5% as it was expected, and RBI has raised inflation forecast for FY24 to 5.4% from 5.1% earlier. MSF rate and bank rate rates also unchanged at 6.75%. RBI has kept withdrawal of accommodation stance unchanged as well, and the Q2 FY24 GDP seen at 6.5%. These are some of the highlights from the policy. CRR also remains unchanged at 4.5%. But Mr. Das mentioned that vegetable prices shock may reverse soon, and that is a kind of relief that is expected going forward. And also he said that Indian financial sector that has been stable and resilient, and that is being reflected in the sustained growth numbers as well. Then let's talk about some of the other highlights. Spike in tomato prices and rise in cereal and pulses contributed to inflation. He mentioned that, and as I stated earlier, that vegetable prices may see a significant correction. So that is a relief that is likely to come, and the economy has continued to grow at a reasonable pace. Upcoming festival season is expected to provide support to private consumption and investment activities. Let's do one thing. Let's take a look at the markets and how the markets are doing after the policy decision. So if we look at Nifty at this point in time, Nifty is down to the tune of 115 points now. 19,515 is the level where we are at. Deep cuts both for Nifty and Sensex. Sensex now down around 400 points, 65,578. Clearly, Street is not really liking the decision, and we'll talk to some of our guests to find out what's the reason behind this kind of profit booking that we are seeing at this point in time. And let's pull up the Nifty bank sector for you. That index should come up, and let's find out what's really happening there. So Nifty bank also down around 358 points, 348 points as we speak. 44,538 is the level where we are at, and clearly Bandhan Bank, ICICI Bank, these are among the top losers. So let's welcome our guest on the show today and find out more about the policy. So we have with us G. Chokalingam. He is the founder and MD at Economics Research, and we also have with us Mr. Amit Somani. He is the senior fund manager at Tata Asset Management. Shal is also now with us. Shal, first of all, coming to you, what do you make of this policy, and what's really not working for the street as we are seeing deep cuts?
So the two things, Tanya, that are not working for the market are incremental CRR deposits of 10%. To mop up excessive liquidity, which the central bank governor has put in. That's a very, very big negative seen by the market, especially on banks. And the top losers are the Nifty Bank, the Nifty PSU banking sector index, the Nifty Private Bank index. These are the top three losers. And of course, the raising of the inflation target from 5.1 to 5.4%. So these two things, and the fact that the governor has repeatedly said that the focus remains in aligning inflation to what we have said earlier, which is 4%. So these two things are what are bothering the market in the short term. But we have Mr. Chokalingam who's seen the market much more than I have. Let's go to him directly. What do you think, sir, are the other things that caught your attention in Dr. Shaktikanta Das's statement?
Frankly speaking, nothing has caught my eyes in a significant manner. Because all are in expected way. The status quo, most parameters, the status quo is maintained. These are all in expected way. So there are two important perspectives I want to present, to understand monetary policy and markets. The one from starting from 2014, the repo rate, benchmark interest rate has come down from 8% to 4% in May 2020. So we had a stability of economy during this process, and then we had a major hit in terms of COVID, which was deflationary. So it came down to 4%. So almost a 400 basis point cut happened. Then the second phase, starting from May 2020 to February 23, the rate has gone up to 6.5%. So 250 basis point rebound happened. But this rebound happened because the inflation went out of control. So now we are at 6.5%. Are we going back to 8% or are we going back to 4%? That is a question. Certainly, in the light of today's policy announcement also, I can make a very bold statement that we are certain to be in the mid-range of around 6.5% or 6%, at least for another 3 to 6 months. And it is possible that this rate can come down to even 5.5% in the next 6 months to 12 months. So that is the forecast, because a lot of good things are happening on the inflation front. We all know that WPI inflation is negative, and the CPI inflation also has come down a lot. Now there are only two problems for the inflation and markets. One is the rising oil price. If you see, oil price used to be as low as 47% on year-on-year basis 5-6 months back. Now world oil price is down just 8% on year-on-year basis, because Saudi Arabia has cut the oil output, so it's going up. This is the area of concern. And then vegetable rice, wheat prices rise in the Indian economy. But if you want to decompose the inflationary impact, there are two factors. One, short-term disruption, like tomato, onion prices, vegetable, fruits prices, they shoot up. That I won't call it as a structural change. That is because of supply-demand gap in the very short term. I would call it as a disruption. Second, the inflation rate jumps or falls because of the structural change. They are bound by the global factors and domestic factors in a big way related to GDP and oil prices. So structural factors are conducive for India's inflation to fall further, because China yesterday they announced certain numbers which show sign of deflation. European economy almost stagnant. US economy has come down, and US oil output is at a record high level. So therefore, the oil price is unlikely to shoot up further, and the slowdown in the growth is also likely to moderate the metal prices. Only copper price has gone up. Still, all other metal prices are quite low. So therefore, India is in a best position, to ride on, the contain the inflation rate, and RBI, to be very straightforward, I think it has no role to play in the stock market for next 6 months, because they have to maintain this mid path of around 6%, 6.5% for at least 6 months. Then they will start cutting down. So there is no worry for the market at all. And the market is falling because your market cap is around 300.
It's down.
It's down because of profit booking. The overall market cap has hit 300. Profit booking. The overall market cap has hit 300. On the growth, one is the banking, obviously, topmost sector, which is 16% credit growth, and followed by automobile sector, and then to some extent the telecom.
Okay,
So
absolutely.
many sectors are growing in single digit. Valuation comfort is not there. So that is the reason for correction in the market. I do believe another 2-3% correction can happen in the stock market in the short term.
Sure. And what are your thoughts on the rate trajectory from here, Mr. Chokalingam?
Yeah, the rate would remain at 6.5 at least for another 1 or 2 months, or 2 even 3 months. After that, it will definitely fall, because the world economy is not going to pick up in a big manner. Oil price is not going to hit triple digit because of the signs of deflationary condition in China and near stagnation in European growth and slowdown in the US economy. Even in India, if you see in July, our oil import has come down to 8-month low. So there are a lot of signs of worldwide correction in the growth. So therefore, oil is also going to be comfortable. And most importantly, the disruption factors which I mentioned, vegetable, rice, wheat, fruit prices. Very interesting data point. As of yesterday, the rainfall has improved. Today, the cumulative rainfall used to be deficit in double digit. Now it is exactly equivalent to the long period average. The cumulative rainfall, there is no deviation. It's an absolutely normal. And second, if you see the spatial distribution, That was also a
Absolutely.
major concern till 2 weeks back. Now, 72% of 36 subdivisions have received a normal or excess rainfall. Even the Kharif
Okay.
area runoff has improved to last year level. So this is only a temporary phenomenon. The vegetable, fruits, and rice wheat prices within 1 or 2 months, all this would start coming down once you really get the Kharif crop number followed by
Okay.
winter crop number.
Okay, absolutely. Let me now, get in. Let me now ask Amit Somani, Mr. Amit Somani. Mr. Somani, what about you? What do you make of the decision, and which sectors, according to you, will be in focus after the policy, and what really didn't work? I think the incremental CRR thing, that is something that the markets are not really liking at this point in time.
Thank you. So I will give this more from a fixed income perspective rather than broad market. But yes, so ICRR is something that market was not expecting, and they gave, I think, back of the envelope calculation seems that it will increase the CRR by about 3 to 5% of what currently banks are required to maintain with RBI. This applies only on NDTLs post 2019, and this comes into effect on 12th of August, and it gets reversed on 8th of September, as mentioned by RBI. So one, I think banking system, I mean, will have to show that additional amount 3 to 5% in terms of parking with RBI. That will have is some impact on whatever the NIMs, if I were to put it that way. But I think beyond that, RBI is also very mindful that one, there was a flush of liquidity in a banking system, given post 2000 rupees callback into the banking system. And July and August are typical months seasonally, shows the currency circulation going back into the banking system, which means that RBI utilized this window, July and August window, to hike this through ICRR, and trying to address it, and then look beyond once the reversal starts happening. As also mentioned by Mr. Governor, that the festive seasons, and I think they are very clear that they always want to maintain a liquidity to the extent that doesn't hamper any credit growth. It seems, I mean, there is a broad number
Right, Mr.
which.
Somani. Let's look at the markets for a while. There has been a drastic fall in both the Nifty and the Bank Nifty. Of course, as you rightly mentioned, it's the incremental additional CRR that's come into the banking space. We've seen a mild
Guys,
green
I'm
tick
not
at
able to hear.
19,530, but unlikely to be held. Mr. Somani, the governor has gone at lengths to describe the wonderful situation that India's macro and micro picture are in. Given the fact that we've corrected, you know, quite okay from the recent top that we've seen on the Nifty and the Bank Nifty. As a fund manager, given the second half is in front of us, what are the sectors that look good to you for you to put in good money?
Uh, I'm sorry, I don't want to get into the sector discussion right now. And this thing, I will leave it to other guests for that.
Okay. Mr. Chokalingam, what are the sectors that look attractive to you at present levels?
Certainly, the banking sector, as I mentioned, the interest rate cycle has peaked out. It's going to fall maybe after 2 3 months. The chances are very high. And second, as I mentioned, the rainfall has improved. Kharif area under Kharif crop also has improved. So that is also going to be positive in terms of containing the inflation rate. Other directly, the tailwinds are also there for the banking sector. The credit growth is now above 16%, which is a 10-year record high. The quality of asset of the banking sector is also at the 10-year record high level. So therefore, yes, there could be some profit booking volatility, but ultimately in the short to medium term, the banking sector would do extremely well, and followed by automobile sector, particularly stocks like Maruti. Personally, we don't have, but we have a bike on Maruti. In general, auto sector will do among the sectors. And third, the telecom, because non-tax revenues of the governments are coming down after exhausting the cash pile of the PSUs. So the one area where the non-tax revenues can be increased is allowing the telecom companies to consistently in a small way to increase the tariff for the public, and that's already visible. So that would be positive for mobile operators. These are the three sectors which would do very well. But otherwise, from a defensive perspective, one can consider FMCG. But if you ask me what can grow faster among all the major sectors, these are the three sectors which can grow much faster.